If I had to summarize the two challenges that the administration faces today and then why that's important for the bond market, it's one that they want to cut spending at the federal government level. They want to raise revenue via tariffs, but they know that if they do both of those things too aggressively, they risk a recession and the deficit will expand dramatically in a recession and it'll be all for naught.
Inscribed underneath the statue of Alexander Hamilton at the entrance to the main U.S. Treasury building in Washington, D.C., is the following quote: "He smote the rock of the national resources, and abundant streams of revenue gushed forth. He touched the dead corpse of the public credit, and it sprung upon its feet." To most bond market practitioners, modern fixed income really began in the early 1980s. During that time, Paul Volcker, then the chair of the Federal Reserve's Open Market Committee, began a plan to crush inflation that had plagued the United States, and thus, perhaps unwittingly, set the stage for a Treasury bull market for the next 40 years. There have, of course, been speed bumps, unexpected rate hikes in the early 1990s, the ballooning deficits of the post-Clinton years, reforms such as the supplementary leverage ratio, and who could forget the events of March of 2020, when the famed basis trade began to unwind. However, in most scenarios, the post-Volcker years have been ones where Treasury remained the flight to quality instrument, a symbol of the awesome reserve currency power of the United States. Yet something happened in the week following the, quote, Liberation Day that makes bond market participants take pause. I'm Amar Reganti, fixed income strategist at Wellington Management, and this is The Investor Exchange, a new podcast focused on asset classes and forces that drive them. I'll be speaking with some of our foremost fixed income experts about their approaches to these important markets. As always, before we begin, I'd like to thank my colleague Thomas Mucha and his team for letting us use this feed from Wellington's popular Well Said podcast. I'm joined by my colleague Connor Fitzgerald, a portfolio manager here at Wellington Management, who, rather uniquely, spends his time looking at the relative value between corporate securities and Treasury markets. Connor, welcome.
Thanks for having me.
The Hamilton inscription, maybe a little cheesily that I referenced in the beginning, really kind of references the fact that from Hamilton and the successors at the Treasury Department, the United States was able to build a sovereign credit market that grew often exponentially and allowed the U.S. government access to pools of capital that had not existed before that time period. I want to focus, obviously, on some of the longer-term themes in our markets, but something did make us take pause, post-Liberation Day, I guess. And I wanted to hear your interpretation of those events and what made them unusual in your mind.
Sure. So a lot to answer in one question, but let me try to boil it down, at least how I'm trying to break it down in my brain. So I think what's unusual is just the sheer size of deficits in the U.S. today. If we go back all the way to the GFC, we had the government sort of put the economy on its back, where the government re-levered while the private sector banks were deleveraging. That trend, I would argue, has continued for quite some time, where the total leverage in the system has stayed relatively flat, but it's come down on the corporate side, come down on the household side, but it's increased massively on the government side of the balance sheet in the economy. And so I think what the Trump administration is trying to do in a way is sort of like balance that equation out, because we're approaching unsustainable levels. You know, anybody can do the math in terms of where deficits will be if we continue to compound interest expense at the levels we are today. So I think when you look at Trump's plan from last fall, the main tool that they have highlighted to generate revenue for themselves is tariffs. I think perhaps one of the things that they underestimated was the impact that tariffs would have on the capital account. What I mean by the capital account is foreign investment into U.S. assets. You know, really up to 2018, we saw a consistent buildup of treasuries held by foreigners. I think they owned about 50% of the government debt market at that point. I think it's down closer to 30 now because, frankly, they've no longer been buying and we've continued to issue. But more importantly, since 2018, we've seen a significant amount of, if you look at our net international investment position, for example, a lot of foreign direct investment, a lot of portfolio equity flows. That's really where that capital flowing into the U.S. has gone in the past few years. If I had to summarize the two challenges that the administration faces today and then why that's important for the bond market, it's one that they want to cut spending at the federal government level. They want to raise revenue via tariffs, but they know that if they do both of those things too aggressively, they risk a recession and the deficit will expand dramatically in a recession and it'll be all for naught. And then on the international side, they can do tariffs and be really aggressive with our various trading partners who we've built relationships up with over many, many decades, but they risk the capital account flight on the other side of those tariffs. But if they don't do tariffs, they don't have any revenue to pay for tax cuts, and the deficits keep going up. So I think they're in quite the pickle, and I think that's really what the bond market is manic about, is those two dynamics.
So there's something interesting in, I think, what you said there. Traditionally, when you are running deficits that are too high, central government would just raise taxes as a source of revenue. In this case, they're trying to utilize tariffs, which haven't been a significant source of revenue in well over 100 years. But I think we can agree that tariffs are just another form of a tax, just spread to different parts of the market, right? Like you could argue it's regressive because, if everyone's buying a piece of cheese that's coming in from abroad, the piece of cheese doesn't care if you're rich or poor, et cetera. You're just buying it, while the tax system, while complicated, tends to be built on marginal tax rates. There seems to be what I would call incongruity there, right? Where you're effectively trying to close the deficit with just another form of tax. Am I wrong from your perspective?
I think that's right. I do think it's a little bit different than, say, just raising income taxes.
Yeah.
Because I think then at least the individual has some choice as to where they can spend their money, and they can choose not to buy one good, and they can choose to buy or not buy some service, right? So I do think it's a little bit different. I do think depending on the product that is coming into the U.S., I do think the country exporting it here will bear some of the cost. So I don't think it's the exact same thing. But I think an analogy I made a long time ago, and I believe it was Secretary Bessent may have made a similar analogy in a much more eloquent manner. If you rewound 40 years ago where there wasn't nearly as much income disparity, you also had a situation where somebody who was living in a trailer park in Alabama couldn't afford to buy a computer, a phone, a GPS tracker. Now that same person can buy an iPhone that has all those things in it that would have cost $1 million in the 80s. And so there's this question of do people that live in the U.S. care about their purchasing power? Or do they care about how their income is relative to people around them? And there's no doubt the thing that they're trying to solve for is that, the top 1% has done better than everyone else because of globalization. I saw an independent research firm put out a piece that just kind of walked through simply the whole thing of how we offshored production, we moved our tax havens to Ireland, and all those benefits accrue to the equity in the S&P 500, and the top 1% gets rich, and the bottom 90% gets left behind. So I think there's an open question of if they could pay a little bit more for goods, but they have a good job that's paying them more money, they might do that trade-off, even if it's a net negative economic benefit to them. I think part of the base that has supported Trump sort of retains that belief, and they don't really care about the top 1%'s equity portfolios.
From a capital markets perspective, how do you think markets have digested that philosophy, I guess? Or maybe less about the philosophy, maybe it's the implementation, maybe it's both, right? In fact, it probably is two pieces here.
Hopefully to try to tie it together, really the only deficit we have is quote unquote cheap goods. We actually export services. So high value add, business and professional services we're a significant net exporter of, but we've offshored the building of widgets, right? So the question is, this idea that people aren't investing in America, I'm not sure I agree with that. The data would show me that there's a lot of foreign direct investment into the U.S. because we've been the best economy on the block for quite some time. There's a lot of portfolio equity inflows. So I think the market is struggling with if we really do face off with a very aggressive stance to all of our trading partners, what does that mean for the capital account? I do think that that's part of the reason Treasuries have effectively not helped portfolios in a recession trade in the market. The stock market was almost down 20% from peak. That's a proper correction. Cyclicals have underperformed. Less cyclicals, we've seen decompression in credit spreads with high yield underperforming investment grade. But Treasuries, the long bonds unchanged in the year, and 5-year notes are 35, 40 lower. That's not that significant of a move. And the Fed has not said anything about cutting. Yeah. And so when you think about the push-pull on those dynamics, I think it's all the things we're highlighting. They ultimately need to find buyers of Treasuries. And if anything, we seem to be incentivizing people to sell Treasuries. I don't think the data would support that folks have sold a ton of Treasuries yet, meaning our overseas trading partners. Yeah. But there is definitely a fear in the market that could be coming.
And that, you think, has sort of driven the steepener that we saw sort of post-Liberation Day from 10s on out in particular?
I think that's a big part of it, definitely. I also think the fact that there's a lot of people that have said the obvious trade is a lower dollar, right?
Yeah. I hate it when people say the obvious trade.
I know. That's the good thing I don't trade currencies. So I think there's a whole host of factors, but I also think if there's going to be more volatility, I think I believe in the concept of term premium. Aside from when the Treasury curve was inverted, for the historic levels of inversion for the past couple of years, we're still looking at a Treasury curve that's exceedingly flat versus history. And if I'm going to be managing assets in as volatile of an environment as we've seen the past couple of weeks and potentially for the next couple of quarters, like I think you should get paid more to own a longer maturity security. Fundamentally, I believe that.
Okay, so that's interesting. And I was going to ask you, like, hey, do you think these effects on treasury markets are short-term or long-term? But I actually want to package that into your term premia question. To our listeners, for those not intimately involved in bond markets, what term premia is the additional premia that a holder of a fixed rate security needs to be paid in case forward rates rise faster than what's currently priced in. Additional kind of comfort and cushion.
I just think of it as you should get paid to lock your money up for longer.
And structurally, let's say everything reverses next week, right? Trade war's over, things go back to normal, tax package reconciliation goes through. Is that term premia growth, or I hate to call it mean reversion, but increase, you think that's likely to be a permanent or longer term feature of treasury markets?
I think the increase in term premium is a structural trend that has just gotten going, and I think it will continue. I'm happy to unpack a couple points there.
Go ahead.
One would be, in a perverse way, low yields on long duration securities almost make people have to own them more. So if you think of a pension or an insurance company, when yields go down, their liability durations lengthen and they need duration even more. And so if you look at, there are some pensions in the US that probably had a 20-year duration in the middle of 2021 when the long bond was at the lows. That number might be like 12 or 13 now. There's much less need for strips for long bonds. So that's one thing. The second thing is I still am a huge believer in the long-term impact of quantitative easing. The Fed, as you know, still owns 30% of the treasury market that's longer than 10 years. That stock effect, I think, has had impacts for the past few years. 100% believe that. Over time, I believe that as we continue to issue more and more net supply from the U.S. government, more of it's getting pushed into coupons. That supply-demand mismatch caused by the stock effect will thaw that supply-demand imbalance and will eventually push 30-year yields higher. But when we were talking about the concept of inflation in late 2021, like if you just took a step back, you're like, okay, we have monetary and fiscal working in the same direction. That hadn't happened for a while.
Yep.
Even in Europe, they're talking about that, whereas
Yep.
they're talking about austerity for the first 5-10 years out of the GFC. You had that happening. You had globalization going the wrong way. You had a shortage of housing. You had greenfield expansion of commodities effectively go to zero. You had all these forces that were like obviously pointing towards more inflation. And then there's a big debate over whether demographics is inflationary or deflationary. I don't think inflation is going to be 5 or 6% sustainably, but I think it's unlikely to go to 1 or 2. I think all those forces are still in play. Like we're in a structural uptrend, and I think the front end of the Treasury curve doesn't look that mispriced to me. It's more the long end of the Treasury curve that I think
interesting.
stands
The
out.
break-evens, at least in the front end, reflect a bit more of an inflationary period. But if you go out like 5 years, even longer, it's like, you're looking at 230-ish. Nothing surprising, kind of given probably closer to where spot inflation is. Do you expect that to be wider? Do you need that to be wider?
I'm glad you brought that up because I definitely want to talk about that. So we had a conversation on email with a large group of folks this past weekend about like real rates at 3%. That's where they were in the GFC, I believe, but that was more because inflation went negative and the inflation break-even market went negative as pricing in deflation. A little bit different situation today. But I think the concept of deficits and crowding out is really simple. Like as the government issues more and more debt, you need to attract more and more capital to fund that. Without knowing where real yields are and what they were historically, all else equal, I would say ever expanding deficits should equal higher and higher real yields. And if I think about a 3% real yield, and I think we should explain like a simple explanation of what this is to listeners that don't go on.
If you decompose a regular treasury bond, it's primarily composed of two things. Primarily. The first is the inflation break-even, which is really the way the market measures it, is the differential between the TIPS bond real yield and the nominal treasury security. So that difference is supposed to be the market's best guess of where inflation is likely to be at that point over given periods of time. When you take out the inflation component, and caveat is you cancel out a bunch of other factors, what you have left is the real yield, which is supposed to be effectively the long-term real growth in GDP of the broader economy. That's what it's supposed to reflect. It doesn't always reflect that. It can be other things, but that is what in a textbook it should reflect.
But to your point, if the borrowing rate in the economy is significantly higher than the natural rate of growth, then that will slow growth in the economy. And if you have the borrowing rate below the natural rate of growth, that's stimulative, right?
Yep.
I would almost argue that we're just back to like normal levels. Like a 3%.
Borrowing rates, yeah.
A 3% real yield, if we think the U.S. economy can grow 2.5% to 3%, 3 is probably a little high, That's not super restrictive to me. And then I lay over this idea of like ever expanding deficits and somebody needs to buy the bonds, which is likely U.S. households because the Fed's no longer buying bonds. I don't know, it's okay, but it's not like a screaming buy to me because a 3% real yield effectively implies if you think inflation's 3% for the next 30 years, you're locking in a 6% nominal return. Like That's good. The long-term equity return is 7 or 8, but I don't know that it's something that everybody's going to be like, I have to own that
Well,
today.
I think before there was this flight to quality sort of perspective that you'd almost be like, I'm willing to pay to have this sort of offsetting, factor in my portfolio.
Which is another great point. So there's a lot of portfolios that are balanced portfolios where they have a fixed income component and they have an equity component, and interest rates and treasury bonds are often sort of the diversifier versus the risky side of the ledger, right? And if we have to have conversations around will they work as they have in the past and as we intended them to, that kind of changes how a lot of folks in the market will approach portfolio construction. Managing in this type of environment is very different than certainly the 2010 to 2020 period, and that's something we're spending a lot of time thinking about.
Broader economy, recession, where do you come out on that?
Sadly, I come out with a pretty high probability of a recession.
Okay.
I don't think that it's going to be a cataclysmic recession where we need to build bunkers inside hills.
Though I will say I like the quote of, it's a recession when your neighbor loses their job. It's a depression when you lose your job. Yeah.
But I think coming into this year, the economy was potentially a little weaker than folks thought or appreciated. And I would describe it more as like the level of prices, like the cumulative amount of inflation that we have experienced since late 2021. People have been sort of like tolerating it and continuing to spend at the same pace. People talk about this concept of excess savings, right?
Yep.
I just think we're at the point where people are like, I just can't pay $500 for a ski ticket, right? And then propagate that through the economy with like hotel prices and the price of a flight to Florida, like whatever it is.
And this is pre-Liberation Day kind of stuff.
This is just the U.S. economy pre-Trump even getting elected. I think it's okay, but I don't think we were growing gangbusters. But then I think the market got really excited about this idea that deregulation and tax cuts could give us another leg up. One of my favorite comments recently is like, when was the last time you heard a politician say no pain, no gain? Every politician that we've lived with for the past 10 to 15 years has been like focused on the 2 to 4 year outlook to get reelected. And I don't take saying that lightly. I just think that's kind of the game, right? They seem to be willing to tolerate a transition period, as they've called it. And the stock market definitely is, this is consensus-ish now, but I don't think the stock market's their barometer for success at this point. So I think there's a good chance of a recession. I don't think it's going to be like a, bank deleveraging, credit crunch disaster. I just think that if I think about my whole career, we've never really had a normal recession. We had the GFC in the first 2 years of my career, and then since then we've had these like one-off shocks that we had, and this is a super important point, I think, epic amount of policy space in either monetary or fiscal, the two most important pillars of, policy support. I think we're at the end of the line. I don't think we can do more fiscal, and I don't think we can do more monetary. I don't think they can go to zero and start doing QE. I think there would need to be something pretty bad for them to fire that bullet.
Again, that put us much farther away from where we're currently operating at.
Because I think it would be sort of an admission that we need the Fed to fund the treasury market.
I mean, that's not the craziest admission, I think, first of all. And I think that's its own other episode at some point.
The last thing I say on the recession, the reason I don't think it will be that bad is corporate and household balance sheets are really strong. Any way you cut it, they really are. The low-end consumer is facing challenges, and definitionally that's why they're the low-end consumer. But I think even relative to themselves, if you look at like different quintiles of income and wealth, they're in better shape than they were in going into prior recessions.
Okay, understood. So that means it's certainly not what you call crisis level recession.
Correct.
But one that, while unpleasant, and maybe we don't know the length of it, isn't as deep as the ones we've faced in the last several years.
Correct.
So how do you think about fixed income portfolio management going into something like this? And given everything you just said about the treasury market too.
First, I think this concept of duration as a hedge, I think duration won't work as well as you think hedging portfolios. So if you thought you needed 2 years of duration to hedge your portfolio in 5-year notes, that might be 4 years. On a forward-looking basis, it's going to be different than what the model says looking backward. The second thing is high conviction in a steeper treasury curve in almost any outcome. In the outcome where everything's fine and Trump gets his tax plan through, I think the long end of the treasury curve will sell off potentially aggressively.
And that's the base case right now. It's very likely that the votes are there to get the extension of the tax cuts.
So I think that presents a risk to the long end. I think with the repricing and credit spreads and how high yields are, I do think there's some value in certain parts of high yield. There's parts of high yield now that are yielding 8 to 9% where they're not without risk and they'll be penalized in a recession, but 8 to 9% is pretty chunky yield. That's hard to lose money on if you're picking companies that don't default over a 2-3 year horizon.
Especially if you're not expecting like the violent sort of default
Correct.
cycle that we might have expected in levered recessions.
Correct. And also to be a bit of a contrarian, like the stuff we're talking about, all the CEOs and CFOs are talking about too. I don't think anybody's taking a ton of risk with their balance sheet right now. If anything, people are probably having conversations of like, how do we extend our option? And I think liquidity would be the final point I would make for companies, but also for portfolio management. Like capital and liquidity in the portfolio is king right now because I think we're going to have opportunities to deploy it at attractive levels in the coming 6 to 12 months. And I just think if you want to survive a challenging period, you got to have liquidity and you got to be able to stay in the game.
Yeah, I mean, it is interesting about that liquidity point. While risk markets are down, the hard data still hasn't actually come in yet.
100%.
Okay, well, I think this was a great conversation, and I'm thrilled you were able to do this. Thanks. I know it's a busy time. Once again, Connor Fitzgerald, a portfolio manager here at Wellington Management. Connor, thanks for joining us here today.
Thanks for having me.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Mark Murphy and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Sermont. Animation support from Rasa Sermont. You can listen to the Investor Exchange at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.